Alright everyone, welcome back to the channel. So you're here because you want to find that next 10x crypto gem, right? That elusive coin that could just maybe turn a modest investment into something pretty significant. And look, I get it, the allure of those massive gains is strong. We've all seen the stories. The good news is it's not luck. There's a method to the madness, a way to invest smartly and significantly increase your chances of finding those high-reward coins in this wild crypto market. And today, I'm gonna break down exactly how I approach this, step by step, so you can too. Now before we even dive into the nitty-gritty, let me get the big disclaimer out of the way. And I really mean this, crypto is risky. Seriously, it's the wild west of investing. Never ever invest money you can't afford to lose. I'm talking about cash that, if it vanished tomorrow, wouldn't change your life, wouldn't make you miss rent or stop you from buying groceries. That being said, with that crucial understanding, the right research, the right strategy, and a bit of patience can genuinely multiply your returns, sometimes in a big way. So, if you're ready to play it smart, stick around. We're not just throwing darts at a board here, we're going to talk about building a balanced portfolio, how to dig deep into new projects, what tools to use, the whole 9 yards. Think of this as your blueprint for navigating the crypto space with a bit more confidence and a lot more strategy. We're looking for those gems, but we're doing it with our eyes wide open and our risk managed. So, grab a coffee, maybe a notepad, and let's get into how to find those potential 10x winners. So, when I think about structuring a crypto portfolio, especially if you're aiming for those big wins but also want to sleep at night, I think in layers. And the very foundation, the bedrock of your crypto holdings, should be what we call the blue chips. This is where you're going to allocate the biggest chunk. I'm talking about 50% of your crypto investment. Why so much? Because these are the established players, the ones with proven track records, massive communities, and significant market capitalizations. Think Bitcoin, Ethereum, and more recently, coins like Solana have been making a strong case for this category. These are your anchors. These aren't the coins that are likely to 100x overnight, let's be realistic. Their explosive growth phase, the one that takes them from pennies to thousands, is largely in the past. However, they offer relative stability in a very unstable market. Bitcoin is digital gold, a store of value. Ethereum is the king of smart contracts, powering a huge ecosystem of decentralized applications. Solana is known for its speed and scalability, carving out its own niche. By dedicating half your portfolio here, you're building a strong defensive line. If the market takes a hit, these are likely to recover faster and fall less dramatically than the smaller, more speculative coins. Think of it like building a house. You wouldn't build on shaky ground, right? You need a solid concrete foundation. That's what Bitcoin, Ethereum, and similar large-cap coins represent. They provide that stability, that peace of mind, knowing that a significant portion of your investment is in assets that have weathered storms before and have strong fundamental reasons to exist and grow, albeit more steadily. This isn't the glamorous part of gem hunting, but it's arguably the important for long-term survival and success in the crypto space. Don't skip this step. It's crucial for managing overall risk. Alright, once you've got that solid 50% foundation with your blue chips, it's time to look at the next layer, the mid-caps. This is where I typically allocate around 30% of my crypto portfolio. Now, mid-caps are coins that have established themselves to a degree. They're not brand new, but they still have significant room for growth. We're talking about projects with functioning products, growing ecosystems, and a market cap that's substantial but not yet at the Bitcoin or Ethereum level. Think of coins like Chainlink, Arbitrum, or Injective as examples of what might fit into this category. These are your growth engines. They carry more risk than the blue chips for sure, but they also offer a much higher potential for returns, maybe not 100x, but a solid 5x, 10x, or even 20x isn't out of the realm of possibility over a bull cycle if you pick the right ones and the project delivers. Chainlink, for instance, is crucial for Oracle services, connecting real-world data to blockchains. Arbitrum is a leading Layer 2 scaling solution for Ethereum, addressing its high gas fees and congestion. Injective is focused on decentralized finance and derivatives. Each has a clear use case and an expanding community. The key here is that these projects are beyond the pure conceptual stage. They have users, they have developers building on them, and they're actively capturing a share of their respective markets. When you're researching mid-caps, you're looking for that sweet spot projects that are established enough to have de-risked somewhat, but still young enough in their life cycle to offer that exciting growth potential. This 30% allocation allows you to tap into that growth without exposing your entire portfolio to the volatility that comes with it. It's about balancing risk and reward, looking for strong fundamentals in projects that are on an upward trajectory. Now we get to the exciting part, the layer that everyone gets really hyped about, the high-risk, high-reward category. This is where you allocate the smallest portion of your portfolio, typically around 20%, and I really want to stress, this is where you're hunting for those potential 10 times, 50 times, or even 100 times gems. We're talking about new coins, very low market cap projects, and perhaps getting into initial DEX offerings or IDOs or pre-sales if you have the appetite and access. But let me be crystal clear, this is the most speculative part of your portfolio. It's akin to venture capital, but for the average investor. With these kinds of investments, you have to be fully prepared to lose everything you put in. Seriously, many of these projects will fail. They might be scams, they might have terrible tokenomics, the team might not deliver, or the hype might just die out. That's why it's only 20%. If one or two of these go to zero, your blue chips and mid-caps should cushion the blow, and your overall portfolio won't be decimated. However, if you do manage to find that one genuine gem in this pile, the returns can be absolutely life-changing, and that's the allure, isn't it? So, how do you approach this? It's all about intense research, which we'll cover in the next chapter. You're looking for something innovative, a strong narrative, a dedicated team, and a passionate community. But even with all that, it's still a high-stakes game. This 20% is your moonshot allocation. It's where you can afford to take on significant risk because the potential upside is so massive. Just promise me you'll be disciplined and stick to that percentage. Don't let greed make you over-allocate to this highly volatile and unpredictable segment of the market. Okay, so you've got your portfolio structure in mind. Now, how do you actually these potential gems, especially in that high-risk, high-reward category, this is where you put on your detective hat and do some serious digging. My first stop is usually CoinMarketCap or CoinGecko. These sites are invaluable. I like to filter by market cap, specifically looking for projects under, say, $50 million or even lower if I'm really hunting for those microcaps. But market cap alone isn't enough. You need to look for strong narratives. What's hot right now? Is it AI-related crypto, real-world assets, Layer 2 solutions, or perhaps decentralized physical infrastructure networks? Catching a strong narrative early can be a massive tailwind for a project. Next up, you absolutely to check the community and the hype around the project. I spend a lot of time on X, formerly known as Twitter, Telegram, and Discord. Is the project team active? Are they communicating regularly? Is the community engaged and growing? Or is it just a ghost town with a few bots spamming to the moon? Genuine engagement and organic growth are huge positive signals. Then look at the team and backers. Are the founders doxed, meaning their real identities are known? Or are they anonymous, which adds a layer of risk? Are they backed by reputable venture capital firms or well-known crypto personalities? Big-name backers can provide not just capital, but also credibility and connections. And finally, one of the most crucial aspects, tokenomics. This is a big one. You need to look at the total supply of the coin, the circulating supply, and, critically, the vesting schedule for team tokens and early investors. If there's a huge unlock of tokens coming soon, that could lead to massive selling pressure and a price dump, something you want to avoid getting caught in. What's the utility of the token? Does it have a real use case within its ecosystem, or is it purely speculative? Understanding the tokenomics can often be the difference between finding a gem and catching a falling knife. A project with bad tokenomics is almost always a red flag for me. Knowing to look for is one thing, but to invest is just as important. For this, I rely on a few more specialized tools. For instance, tokenunlocks.com is fantastic for tracking those vesting schedules I just mentioned. It gives you a clear calendar of when significant amounts of tokens are set to be released into the market, which can heavily influence price action. Another go-to for me is DefiLlama. This site is incredible for tracking total value locked-in DeFi protocols and across different blockchains. A rising TVL is often a strong indicator of growing adoption and user trust in a project or ecosystem. For more in-depth research, especially for new and upcoming projects, I often turn to platforms like CryptoRank or Masari. These sites provide detailed reports, project analyses, and often have calendars for upcoming token launches and IDOs. They can be a goldmine for information if you're willing to put in the time to read through the research. Now, let's talk about timing your entry. A common mistake is buying early, like right at the peak of launch hype, or even worse, chasing a massive pump. Many new coins experience a significant pump immediately after launch, primarily due to initial hype and low liquidity, only to then dump hard as early investors and flippers take profits. My strategy is often to wait. I set price alerts on coins I'm interested in, and watch for a period of consolidation after the initial volatility. This is when the price settles into a range, shakes out the weak hands and potentially builds a base for the next move up. Don't be afraid to miss the first crazy pump. Often, a more sustainable entry point comes later. It's about being patient and not letting FOMO, or fear of missing out, dictate your investment decisions. Look for signs of strength after a cool-off period. That's often where the smarter money starts to accumulate. This disciplined approach can save you from a lot of heartache and financial loss. Alright, that was a deep dive. We've covered portfolio allocation, research methods, and some key strategies for finding those potential 10 times crypto gems. It's a lot to take in, I know, but breaking it down like this, I hope, makes it feel a bit more manageable. Remember, this isn't about getting rich quick, it's about smart, calculated moves in a high-stakes environment. Before you go, I want to leave you with 3 final gems of advice, things I constantly remind myself of. First, don't chase pumps. Seriously, if you see a coin up 200% in a day, you're probably late. The smart money buys red days and sells into green hype. Second, embrace dollar cost averaging, or DCA. Don't go all in on a coin at one price point. Instead, break up your investment into smaller chunks and buy at regular intervals, or when the price dips to levels you're comfortable with. This averages out your entry price and reduces the risk of bad timing. And third, perhaps the hardest one for many, take profits on the way up. Greed is a portfolio killer. If a coin does a 5 times or 10 times, take some profits off the table. Secure your initial investment, maybe a bit more. You'll never go broke taking profits, and it allows you to reinvest in other opportunities or de-risk. Phew! If this breakdown helped you out, if you got some value from this, do me a huge favor and smash that like button, it really helps the channel out. And make sure you're subscribed with notifications on so you don't miss the next video. I'm always looking for new gems and strategies to share. And hey, comment below if you want my next gem of the day idea or if you have any questions. Let's navigate this crypto journey and build together. Thanks for watching, and I'll see you in the next one.